This podcast is intended for educational purposes only. It is not to be construed as an offer, solicitation, recommendation, or endorsement of any particular security, product, or service. For more information, visit AssetBuilder.com. From the AssetBuilder headquarters in Dallas, Texas, welcome to the Keep It Simple podcast, a show that discusses simple techniques and philosophies to help de-stressify investors around the world. I'm your host, Joey Badinger, and welcome to the Keep It Simple podcast. All right, welcome back, everyone, to the Keep It Simple podcast. I'm your host, Joey Badinger. We are based out of the AssetBuilder headquarters here in Plano, Texas today. And we're going to be going over a short podcast, a smaller topic today. And we just want to review 4 common biases we see a lot of investors fall into. Now, I want to make sure this is clear. We here at AssetBuilder are not better than anyone else, right? We are still human. We can still fall into these 4 biases as well. We just do a very good job at combating them because we have to fight them on a daily basis so we get kind of used to it. And we also have a system of accountability to make sure that we check each other if we are falling into these biases. So what are these 4 biases that we have to fight? Number 1 is overconfidence. Number 2, recency bias. Number 3, herd behavior. And 4, confirmation bias. So let's go over that first one. Overconfidence. What is it? This is overestimating your knowledge or ability to predict markets, right? You might have bought a few stocks and in 1 year you just absolutely killed it, right? And maybe in 2 years, the next year, you killed it again. You had a really great return. But now you're starting to think that you are better than everyone else in the market, that you can outperform the market on a consistent year-to-year basis. And so what can happen, this can lead to excessive trading, right? You start to buy and sell out of positions all the time because you have a new thesis on something that's going to outperform, which can overturn your account. And then there is under-diversification, right? You're going to jump in because you're very confident in this one stock or this 2 stocks. You go all in on them and you are under-diversified. And when a bear market or a downturn hits, you are kind of in a world of hurt there, right? Or really overexposed to just the performance of 2 companies for that matter. And also it tends to lead to ignoring good advice in market data. Over the long term, it is really, really hard to outperform the market. We got to remember that there are other people on the other side of that trade that have their PhDs in finance or economics or other areas that are really smart. And we've got to remember, take a little bit of a humility pill and say, am I consistently going to outperform those guys on a year-to-year basis? So just be careful there. That's what overconfidence tends to do. Something that we can do to combat that is keep a written investment plan, right? This helps you stay to the fundamentals. It helps you stick to your goals. It helps you stick to your plan and not stray from it, right? That's where we can get a little bit, this is where that overconfidence can creep in and start to have its effect. So we got to be careful. Another thing is you can keep a benchmark. And what I mean by this is, let's say you have a portfolio of 30 stocks, right? At the end of the year, compare it to an index, right? Like the Russell 3000 or the MSCI ACWI, which is the All Country World Index, right? Which takes into account all of the stocks in the world or gets a good pulse on the entire market. So compare it against that, see how you did. And hopefully you did better. Obviously, I want you to do better, but sometimes you probably won't. But it's a good way to check yourself and make sure you're not getting overconfident. And then also just stay humble, right? That is more of a mindset. Make sure that you realize you are not always the smartest person in the market. There are a lot of people that participate. So yeah, staying humble is one of the key things to avoid overconfidence. So number 2, the second bias that I want to talk about, and this is recency bias. This is giving too much weight to recent events in the market. After a big rally, right, we might think that stocks are never going to go down again, and then that can lead to performance chasing. We only start buying the things that have recently done very, very well, but we know that doesn't always persist. Or when there's a crash, we think it's just going to keep on going down until it hits 0, which that tends to lead to panic selling, which can really hurt us in the long run. If we're a long-term investor, panic selling can be one of the worst things you can do. So we got to be careful about recency bias. Some of the most expensive 4 words in investing is this time it is different. right? You're right. This time it probably is different. There are going to be different variables pertaining to each particular market situation. But one thing stays the same, especially when we're talking about a crash. One thing stays the same is that we will rebound. We got to remember, most people that are listening to this, I myself, have experienced bear markets. Most investors will experience about 10 to 12 in their lifetime. But that does not mean they're rare or unheard of or necessarily a bad thing. Markets are cyclical. They actually tend to produce a buying opportunity, especially for younger investors. So don't think that it's always going to stay that way, right? I'm talking about bear markets a lot here. Also in good markets, don't think that it's always going to stay that way. It's always going to go up, or the recent winners are going to be the continual winners every time. That tends to not persist, and we tend to get burned by performance chasing in that case. So remember, we got to look at long-term trends. One thing to do to overcome recency bias is to look at long-term trends. Remember your principles, the things that you wrote down, the investment plan you have, and stick to that. And don't stray too much from it. All right, number 3, right? This is the third bias, is herd behavior, basically FOMO. You're following the crowd and what they're doing, right? We got to remember that different people are playing different games in the market. Someone that is a long-term investor should not take their cues from a day trader. That's when you can get hurt as a long-term investor. And for the most part, that's what we are here at AssetBuilder. That's what I'm mainly talking about. Now, I can't really talk to day traders because they trade on a daily basis. But for those of us that are long-term investors, we got to take our cues from our financial goals and our financial plan or our investment plan rather than what someone else is doing over there, right? Or day trading over there. You guys remember the GameStop craze, right? I don't think a lot of people were investing in GameStop because it had good fundamentals. A lot of people were investing in GameStop because that's what everyone was doing. And then a lot of people got stuck holding the bag because they bought in at a high level and then things popped, right? The bubble popped on GameStop. That's what tends to be dangerous with recency bias. They tend to lead to buying high, selling low, which is the opposite of what you want to do. And then it also creates bubbles in emotional investing. You don't want to miss out on any of these things, so you just buy in, you get in. And I'm not saying you can't play around with a little portion of your portfolio. Like if you want to buy cryptocurrencies or anything like that, be very careful. Just be fully informed with that and do it with a small portion of your portfolio. Don't do it with the entire thing. So just be careful. Ask yourself, this is one way to combat recency bias. Ask yourself, would I still be buying this if no one else was talking about it? Remember, stick to your investment plan. And this way you can help avoid herd behavior. All right. And the last bias that we have to combat on a daily basis or a week-to-week basis, monthly basis, yearly basis, this is confirmation bias, right? This is where you don't want to hear any of the bad news. You only want to focus on the positive, right? So this is what happens is we tend to skew our research towards things that back or are positives towards our theory, right? Things that we want to see happen, we only find research that supports those things. We don't look at or listen to negative earnings reports or negative views or articles written about the investment strategy or the company or the stock that we want to buy, right? This can reinforce bad decisions, right? You can make a bad decision with a lot of research behind it because you didn't look at the other side of the research, which is the negative. So got to be careful. Things to do to overcome this is to actively seek disconfirming evidence, right? Find articles that don't agree with you, right? This is not fun. I want to make sure this is clear. This is not fun, right? Because you want to be right. People want to be right. I want to be right. I feel that. But it is good to hear the other side of the argument. It is good to understand it. And that way you have a more informed decision that you're making, which tends to be a better decision and one that you are more, one that you can get behind better. So make sure you reach out or seek out and find that non-conforming evidence and make a habit of asking yourself, what am I missing? Right? Always ask yourself, what am I missing? Because there are very smart people out there that might know more or that might have a different view than you. And it is good to try to understand their position on it. All right, y'all. So those are the 4 biases, right? We have, one more time, it is overconfidence, recency bias, herd behavior, and confirmation bias. These are 4 things that we've got to fight against or combat every single day, every single week, month, year, to make sure that we make wise investment decisions to the best of our ability. Thank you all so much for tuning in. And as always, hope you have a good one. Bye. If you have any questions for Adam, Janet, or Joey concerning this topic or anything else, send us an email at podcast@assetbuilder.com or visit us at our home on the web, assetbuilder.com, where you can set up time to meet with an advisor.